the markets globally have been influenced by numerous dynamics, not least of which is central banking policy, currency movements, as well as the less usual war, sanctions, and so on. Particularly Europe, where we're finding the greatest opportunities, where we have been for the past 2 or 3 years. So Europe has been by far least loved, most undervalued, and most distressed. Just to give you some sense, the U.S. is trading on roughly 16 times forward earnings. Europe is trading on roughly 15 times forward earnings. So not a vast differential. Now, having said that, on Shiller's cyclically adjusted PEs, the U.S. is trading on 26 times, while Europe is trading on 14 times cyclically. So there's a vast gap. And furthermore, why are we attracted to Europe? And first and foremost, we're able to find far more undervalued stocks in Europe than any other region. And there's plenty of pain, plenty of pessimism discounted in Europe's valuation. Just think you've had macroeconomic GDP forecasts getting revised downward as economic activity slows down. Clearly a sustained or persistent high level of unemployment. Within the Eurozone, it's on the order of 11% plus. Furthermore, they've had to contend with austerity as Germany had to some extent forced their wishes upon the Eurozone or the monetary union to fiscally consolidate and to follow a more austere type of policy. So if you have the consumer unemployed with less disposable income, and then you have the state spending less, and worse yet, tightening the belt. And then finally, you have the ECB with not a lot of tools or degrees of freedom to stimulate. And that in of itself led to a dire macroeconomic environment, and clearly the profitability, the revenues and profitability of European companies have been impacted. Where we're finding the greatest misvaluation, or I should say the most depressed valuation today on a sectoral basis, it's really more in the more cyclical side of the market. So think industrial companies, capital goods companies, materials companies, as well as energy and financials, banks. And some of that is for good reason, as our starting point, roughly a few years back, the valuation was quite peakish, toppy. The earnings were quite toppy, and the returns that they were generating were also quite toppy. And they've gone through the correction. There's been a vast amount of capacity that has come onto the market, low capacity utilization, rendering their pricing power relatively mute. Commodity prices, oil prices have come down. Clearly their profitability has suffered as a result of that. But what's happening at the moment is that the valuation has contracted, but there's a good bit of self-help. We're seeing these companies restructure, reduce cost, come out of projects that are non-profitable, and so on. So there's a good bit of proper governance taking on to drive returns and unlock value. Furthermore, we're actually seeing a good bit of M&A to consolidate capacity, consolidate pricing power, and take out cost. And we're finding a good bit of value there too. Furthermore, we think the implied price per barrel or price per ton of iron ore, the implied underlying commodity prices, by the current valuation is significantly lower for much lower. We think perhaps sentiment has overshot, and at some point the global economy, parts of the global economy will begin the process of healing. We'll see capacity utilization pick up, as we have indeed in some industries and some geographies, and we're likely to see at some point a reinvestment, or companies invest once more in capacity. And clearly that will be favorable to industrial capital goods companies as well as materials companies. This world is changing from an economic, from a policy, from a valuation, market valuation that has created opportunities. There's the so-called Fragile Five, which includes Brazil, India, Indonesia, Turkey, and South Africa. And they're considered fragile because during the economic boom of decade, when their economies were doing better, when they had the fiscal capabilities to reform their economies, to wean their societies off subsidies, food, energy, your typical, they did not do so. Furthermore, there's a good bit of dependence within these countries on commodities. In the cases of like Brazil, Mexico, and South Africa, they're exporters of all things commodities, and clearly with a China slowdown or a slowing appetite for resources, that impacts their exporting sectors. So in the meantime, their domestic economies aren't large enough, don't have the robustness, the adequate robustness to pick up the slack that's impeding their overall economy. As a result of that, these markets have behaved differently. Brazil is significantly cheaper than normal. India not so much so, and that's mainly because of the election of Modi, and therefore the reform of the economy is already discounted, and better future is already discounted. Our view is that the likelihood of a disappointment there is pretty high. Conversely, Brazil now with the election behind them, and what we saw is that Rousseff did not win a landslide, and the more friendly candidate actually was the big surprise. So we think real economic reforms are of a higher probability, and yet the Brazilian market continues to offer significant opportunity. Other places, Turkey, we touched on the fragility of its current account, because they import 100% of their energy. Clearly having trade partners in the Middle East, in places like Iraq, with the geopolitical tensions, that is having an impact both on their economic growth, but also on the risk premia being demanded of their markets and their equities. So it is very much becoming, from an opportunity perspective, a richer global market, but one needs to be certainly more selective, pay a lot of attention to discipline, pay a lot of attention to valuation, pay a lot of attention for expectations.